Hey guys, this is Chris with another stock analysis video, and over the past few days, weeks, and months, it has not been easy as a growth investor. Alright, pretty much since Valentine's Day when the Nasdaq first topped out, we have been seeing a lot of weakness in this area. I have not been getting any love from my stocks in particular. Clearly not smooth sailing for a lot of these stocks, and in the meantime, you have a lot of stocks that many investors, especially the younger generation, are not really invested in and are not really interested in, like financials, industrials, and retail type of stocks. However, in my quest to find more good stocks for everyone and for my own portfolio so I may stop hemorrhaging and taking losses day after day after day, 1 or 2%, it kind of hurts when you add it all up. We're not that far from my all-time high, but I'm sure a lot of people are, again, down if you are heavily invested into that area of the market, which is tech and growth, and especially SPACs. I wanted to find some restaurant stocks. These are stocks that I typically have never really looked that much into except Dave & Buster's, and I wanted to find some cheap stocks that could benefit from pent-up demand, the economy reopening, people coming back outside into the world and spending all of that stimulus money and money that's been saved up by households to a record level when they're not spending that money on games on Roblox, Amazon products, or their fancy new shiny Peloton. That is also a bit dangerous and cannibalistic. So we're going to see here that I looked at different restaurant stocks. You can go on finviz.com and look up the category. Personally, a few of them came up to mind, like Darden Restaurants, I know is a really strong brand. What I then did was I'm going to look at the whole sector and see what's up there. So I pull up this list and I look through each of these line by line to see what strikes me. And the bottom here, the last ticker symbol, FAT, fat. All right, so I'm thinking this must be good. And this is how it all started, to me figuring out the fat ass man portfolio. I'm not even joking, but this is the sad truth to the market that we're in right now. These three stocks, fat ass man, might be the three best stocks that you could invest in right now. Fat Brands is a franchise company that owns about 9 or 10 different brands here today. They have 700 stores franchised, and a lot of them is fast food, fast casual, a lot of, hip type of brands that are up and coming. It is a very small company overall, around $100 million market cap. So it's not even a small cap really, it's like a micro cap. And a lot of these do tend to be a bit more speculative, but when I look at some of these fundamentals, it is kind of interesting here. So the forward PE ratio is around 18 as of this recording. It's a under $10 stock. And that represents a pretty good value, I must say, when you compare the market overall as far as forward PEs. 18 is pretty good. In the restaurant space, it is a bit higher than some of the other more established names. However, this is a smaller company, right? And we are expecting more growth for this company. So you can see in the latest quarter, they did grow around 20+%, which is not half bad considering the environment that restaurants were in over the past year, where people were not going outside and eating in those dining rooms because you could die. However, what you see here is in the coming year, this analyst, yes, one analyst for this company, expects around 80+% growth, and definitely looks possible. But as business improves for those 700 stores, those franchisees are going to have to pay commission and royalty to Fat Brands, and they're going to get some fat returns, hopefully, from those stores. And they're expanding very rapidly right now across the world. They're international. They have a plan in place in France, so they're in Europe, they're in Africa, they're in a lot of countries at the moment, and getting a lot of traction. So those revenues could increase quite fast. And of course, again, they are expected to be profitable from this operation. And to fund all this growth, they also recently got a line of credit for over $144 million. So they look pretty well capitalized to expand and potentially take advantage of a reduced playing field post-COVID. A lot of local restaurateurs have probably gone out of business, and that leaves some opportunity for these fat brands to get some good profits. All right. Last note on fat brands is their fat dividend, which annualized represents around 5% yield, which is very, very high and unusual for a growth company and a pretty small company at that. So, not sure if this is going to last. If you look at the dividend history, they only really consistently paid a dividend in 2018. So, it might not be a dividend they're going to pay out every single quarter, but there is potential, and it does signal that the management believes the company is financially going to do very well, and they're going to be able to afford to pay this dividend, at least for the past quarter. So to sum it up, Fat Stock has been getting some oversized gains year to date, and over the past year, the 52 weeks, it's gotten around 400+% gains. So very meaty stock that we have here. I'm going to stop that. And we're going to move on to stock number 2. In my quest to find more industrial related stocks that take advantage of infrastructure spending and all that money that's out there, and people want to use take advantage of low interest rates to really build out and grow their operations, you're going to see that I found this stock and it is ass. All right. AZZ actually. So that's what they go by. I'm sure management, they probably know what this ticker symbol looks like and the name of the company, but they do refer to themselves as AZZ. So when we talk about ass, this is a company that does the infrastructure of infrastructure. Okay, so they do metal coatings for various things, powder coatings. And metal is used to make pretty much everything nowadays, but especially when it comes to heavy equipment and machinery. And they also do electrical products and other things related to infrastructure. So they're a pretty diversified business. They are the number one in metal galvanizing in the United States, and they have a pretty good track record when it comes to growth of this company. Pre-pandemic, they were doing some pretty strong growth. You could see year after year, this company was increasing its revenues, 700 million, 800 million, 900 million. But it did tail off last year, definitely in the early parts when things were more shut down and manufacturing was at a standstill. Now we can expect a lot of growth going forward, especially profitability for this company, because over the past year, they have exited some less than stellar types of their business, the ones that are not very profitable, and focusing on their main businesses and developing their margin, cutting costs so that they are more profitable going forward and take advantage of this high demand and inflation that we're seeing in the whole world, really. This company's products are needed for all of the end products that are so important to our society. And with the forward P of 17, I think that this is a really attractive stock. And lastly, stock number 3, okay? I didn't even know this stock existed. However, I was thinking to myself, okay, I want to make a video about 3 different stocks. I already have fat, I have ass. What goes with fat ass? And the first word that came to my mind was man, okay? And if you look it up, there is indeed a company with a ticker symbol, MAN, MAN, okay? MAN Manpower Group is a $7 billion company, $122 stock here as of this recording. And what this company does is it is a staff hiring firm, all right? So essentially, it helps other companies fill positions. They look for qualified employees for them. And you may have used these hiring agencies in the past yourself when it comes to finding a job. And they get a commission off of that person's wages typically. So that's how they make money. And the great thing about this company is that a large part of the industries it works with to find those hires, and they're global, by the way. They're in Europe, they're in America, they're in Asia. The main industry that they're in is manufacturing. And again, we know manufacturing is taking off like a rocket over the past few months, and certainly going forward in the next year or two, potentially because of all the infrastructure because of all this spending, etc., etc. So this does have a company with some very good tailwinds. The past year, obviously, the overall employment situation globally was trash for the first several months, probably the first half of 2020, right? When unemployment was so high and manufacturing was hit very significantly. And it has a forward PE ratio that is around 15, okay? So it's even lower than fat and ass, okay? So that's already a really good sign. And man, this looks really good. The goal ultimately is for unemployment to reach around a 3% mark, 3.5, where it was pre-pandemic. And I'm sure a lot of other countries will be also very accommodating, have very accommodating policies. They want corporations to continue to expand and hire so that people, the maximum amount of people that can have jobs, get them, and everyone's happy and have a nice income. And this company is pretty much poised right in the center of things to take advantage of that, because those people are gonna need agencies like this to help them find a job. And likewise for these corporations that Manpower Group works with, they're gonna need an easy way to find qualified individuals and not have to deal with so much hassle. This company, by the way, pays a 2% dividend yield, similar to AZZ, and they can probably expect to increase that going forward. And they do plan to also buy back more shares as well, increasing shareholder value. Lastly, you look at this company's balance sheet, by the way, and it is very clean. It does have a net cash position, meaning that they have more cash and assets on their balance sheet than their debt, so they can always pay it back. They're not in any cash crunch, and they can focus on running the business as profitably as possible. So there you have it, guys. This is my fat ass man portfolio. Let me know in the comments down below if you enjoyed this type of video. It was a bit silly, but I gotta say, these are some really dang good stocks. You know, don't mess with the FAM, you know, right here. So if you're gonna buy these stocks, let me know in the comments down below as well. And until next time, my friends, stay well and invest responsibly.